Good afternoon, everyone, and welcome to the third episode of our From Pockets to Portfolio series. We are thrilled to have you all here today for what promises to be an enlightening and engaging session on financial wisdom. My name is Saniya Chawan. You must be knowing me by now. My manager certifications and engagements at FPSB India, and I'll be introducing you to our speakers for this webinar today. So we have the pleasure of having Apurva Sahijwani, the MD and CEO of Avendus Wealth Management. Apurva has joined Avendus Wealth Management Limited as Managing Director and Chief Executive Officer in May 2024. And prior to joining Avendus, Apurva was the head of private banking and was instrumental in launching and scaling up the Burgundy Private Axis Bank's private banking business. He has over 25 years of experience in the business of private banking and wealth management and have worked in senior positions across Axis Bank, Kotak Mahindra Bank, Citibank, HSBC, and ICICI Bank in the past across a variety of roles encompassing relationship management, investment advisory, and strategy. He's an MBA from KS School of Management and Research, Gujarat University. He also holds a diploma in business finance from ICFAI, Hyderabad. Under his leadership, Avendus Wealth Management has been awarded the Best Private Bank in Alternate Investments at the Global Private Banking Innovation Awards 2024. We are truly honored to have him here with us today to share his insights. And joining him is our Arun Thukral, CPAC Chairman at FPSB India, who will be interviewing our guest today. So over to you, Arun, sir.
Thank you. Thank you, Saniya. And welcome, Apurva. Thank you for your time. And we are really excited to have you with us today. And as you know, this particular series is about CEO's personal money management journeys. So as a CEO, obviously, you handle large amount of money and you have a lot of things to do. But this is specifically how you started your journey. And incidentally, you are also in the same business. You also advise people how to manage money. So it's a bonus for us. Our audience is primarily CFP certified financial planners or budding planners. So first thing first, so maybe I should start with at what age actually you started saving money, or maybe a little bit about your early career, and then we can take it from there.
Sure. First things first, Arun sir, thank you so much for giving me the opportunity to come and interact with you and all our participants today. It's a pleasure and both a privilege and a pleasure to be here with all of you. My journey has been actually quite interesting. I made this point, Arun sir, about me being in the same business as is the subject of our webinar today. Somebody told me very early in my academic life that if you're not fortunate enough to have your hobby as your profession, you should have your profession as your hobby. Well, in my case, fortunately for me, my hobby is indeed my profession. So I've enjoyed every single minute, every single day of working in a variety of roles, as Saniya mentioned in my introduction. I have managed client relationships. I have advised clients. I've also been responsible for building businesses. But the one thing which has been thread across all of this has been that this is all being done within the wealth management domain. So yes, my journey in this business has I'm in my 26th year now, and I tend to continue doing this as long as I can. My investing journey is slightly shorter, and I think that has made all the difference. So while I started working 26 years ago, I started investing 22 years ago. And if you ask me if there is one thing which I should, if I could change something, I would go back in time and pull up my younger self and tell him, why didn't you start investing on day one? Unfortunately, as you know, typically in the early stages of one's career, one tends to be a little cavalier about investing and focuses more on spending. I think I made the same mistake. But yes, given a chance, I would probably undo that mistake now and would have started focusing more on savings right at the early stage.
Great. I think that's what you said about the hobby being the profession. I think the Warren Buffett talks about that I am getting paid for doing the work I love. And
Absolutely.
That's what they say, that if you love your job, then you will go dancing to your workplace. Yes. So I think luckily, I think for both of us, even I also feel the same way. So I wanted to know, is there anything which comes to your mind, or any mistake or any challenges in the early part that you did some goof up and then later on you realize that I would not have done that. So if anything comes to your mind, you can share with us here.
Several goof ups, sir. I think I can author a book on all the mistakes. I read a book once authored by a very prominent author called Three Mistakes of My Life. I think I could write on the 30 mistakes of my investing life. But I've heard you say this before, that every mistake that you make is a tuition fee that you pay to make sure that you don't commit that same mistake again. I think we all commit mistakes. The key here is that you should commit new mistakes rather than repeat the old ones. So yeah, I think to me 2 or 3 mistakes which come to my mind, which in hindsight, I think I should have been a little more judicious. One is, of course, like I just mentioned, I started investing later. That 4-year gap between the time I started earning and the time I started saving, to my mind, has made all the difference. I think another very interesting thing which I realize now is that, and this is, I've created my own cardinal rule, something which I keep reiterating to all my clients and to my teams, is that, there are 10 commandments in Christianity. I think there are only 2 commandments when it comes to investing. The first commandment is thou shalt not put short-term money into long-term assets. And the second commandment is vice versa. Let me explain. I think one of the mistakes which people make is that they tend to keep money which they need, decades down the line in instruments which are extremely liquid. Where they can access this money perhaps, in a day's time or maybe even shorter. I think that's a mistake, because compounding happens only in long-term assets, and which is why one needs to be very judicious about not putting long-term money into short-term assets. The other mistake is, in fact, the mirror image of this, which is that people tend to invest short-term money in long-term assets. And I think, unfortunately, that tends to come in and impact them very hard, because it has the potential of impacting their capital. We've known of people who needed money a few months down the line, and they have gone and invested into long-term assets where, the vagaries of the market have kind of exposed them to huge amounts of risk. I think this has been the second learning. To me, I'm very clear. I keep telling my teams also about the fact that if you follow this commandment for managing your own wealth and your clients' wealth, chances are you will never go wrong. Third has typically been, in terms of the approach that one has followed. For most of my career, I have been an investor in mutual funds. But in the early stages of my career, I used to second guess mutual funds. Let me explain to you what I mean by that. I used to, on occasion, buy small cap and micro cap stocks and invest in large cap mutual funds. Today, I realized that was a very foolish thing to do, because ideally your own stock portfolio, depending upon whatever is the ratio that you work with in terms of others managing your wealth and you managing your own wealth, logically you should have in your own portfolio the bluest of blue chip stocks which you can hold forever. While when it comes to the so-called mid, small, micro cap stocks, honestly, individuals are generally not experts. The experts are people out there who are managing money. So you should let them do that job by entrusting your money to them rather than taking that decision yourself. So yeah, these are just some top of the mind mistakes which I have committed in the past, and which hopefully I will not repeat going forward, that I thought I must mention.
Yeah, I think the learnings are huge from any mistake. And why we ask this question specifically to the people who have reached at that level, at the CEO level? Because general perception is that if somebody has reached at that level, he would have been very wise. But I think most of the guys I talk at this level, I think everybody has committed number of mistakes. And I think some even love to tell me that I love committing mistake. And because the learning is so huge, so that I'm thinking of committing some more. So
absolutely.
Yeah. So learning from mistake is more important than committing mistakes, I think.
True. I completely agree that.
Yeah. And you spoke about the equities or the micro cap stocks or blue chip stocks. So maybe a little bit you can touch upon the asset allocation in your case. And maybe you love stocks or gold or property or cryptocurrency. So what is your view on asset allocation, and how are you managing it in your portfolio?
No, I think asset allocation is pretty much at the core of managing wealth, whether it is your individual wealth or the wealth for your clients. So I think the more time that you spend in terms of deciding upon the right asset allocation, the easier the journey will be. It's like using a navigation for a road trip, I mean, if you do your preparation, what time you should start so that you can end at what particular time, and what is the distance that you need to cover, what is the shortest possible route that you can take to get there. I think that's really, to my mind, the analogy for asset allocation. So I think it's a very, very high priority item in any discussion pertaining to wealth management. My own asset allocation is actually, I must confess, a little lopsided, because I've been a long-term investor. And like I said earlier, that my learning is that if you're a long-term investor, you should not put money into short-term assets. So my portfolio has generally comprised of long-term assets. I think it's largely divided between two asset classes, between equities, and I do have a reasonably, well, it's not a very large percentage, but I do have a 10% constant allocation to gold. I've been a believer in gold. I do believe that anything which is limited in terms of supply has the ability to generate consistent returns, and gold is clearly one of those commodities which is limited in supply. So to me, that 10% allocation to gold has been a constant. At whatever level of portfolio I've largely maintained that 10% allocation to gold. Equities to me has really been the core of my portfolio, because I've been a big believer in the India story. Having seen, I'm a 70s child, so I've seen, the economy transform over the last 4.5 decades. And I've seen the way, our economy and capital markets have been very, very strongly correlated. I firmly believe that, as the economy progresses further, capital markets in India will reciprocate. And, that is, to my mind, the best way of looking at consistent and long-term compounding. So my personal portfolio has a focus on these two asset classes. I stay in my own house, so that is my property exposure. But as you are aware, that's not something which you should include in your computation of wealth. So I make it a point to exclude that. Other than that, there's no other investment that I have, not at this point in time.
Any word on cryptocurrencies? Because nowadays everywhere you go, and all the Gen Z investors, and when you go around, that everybody talks about that. So what is your view? Maybe you are not invested there, but any view?
Sir, I have a secondary golden rule, which is that I don't invest in something which I don't understand. And I must confess, I don't understand cryptocurrency. I don't. I've made a lot of effort to understand. I've made a lot of effort to figure out how it works. But I must confess, I'm a novice. So the one thing which my mistakes of the past have taught me is that I will not get into something which I don't understand, which is the reason why I've desisted from investing in that space.
Yeah. So you wanted to know, because everybody see most of the guys from my time and even from your time, you are much younger, but still I think only the young guys nowadays, I think they talk about this more. And over a period of time, let's see if there is some value, we would also know. But yeah, there has to be some view about this, and that's why I wanted your comment. And coming back to your asset allocation, do you link it with the financial goals, or like most of the guys, most of the time the planner would advise that these are your goals, and once your goal is met, and then you should take that money out and shift it. How important is the goal matching process?
No, I think the goal setting process is extremely important, and I do have some of these goals which I've set. I'm still not at that stage where those goals have come to fruition, which is the reason why, to me, this is a work in progress, where I'm kind of still catering towards these goals. These goals are conventionally the same as it would be for most people, in my age bracket. There is retirement, there is child's education, there is obviously, um, contingency planning, and so on and so forth. But to me, all these investments have really been a means to that end, but that end is still some time away.
Great. Being part of the same profession, whether it's an advantage or sometimes you become too calculative, or sometimes maybe when you want to spend money, whether that thought comes to you, whether if I would have invested, if I invest this money maybe 5 years down the line, maybe delaying some of the wants. So needs versus want stories. So what is it sometimes comes to your mind, being a wealth manager or private banker all your life, and now heading a company of the same domain. How does it affect your thinking about money, your relationship with money?
That's an excellent question, Arun sir. I think sometimes it is said that familiarity breeds contempt, but I disagree. I don't think that is the case. I think understanding, wealth, the way it is managed, the way it is, of course, created, has been a very, very big advantage, because it gives you a sense in terms of how, to act or how to react when you're faced with a certain situation. Clearly over the last now close to 3 decades that I've been working, I've seen multiple bull and bear markets. I think every bull and bear market has a lot of learnings, and you tend to make sure that you kind of identify what are the symptoms of these bull and bear markets. And these bull and bear markets don't tend to be only in equities as is normally perceived. I think every asset class has seen bull and bear markets. Properties have seen these markets. Gold has seen long-term bull and bear markets. We've also seen similar kind of movements in fixed income. So it's not fair to say that these markets are symptomatic only of equities. I think having seen some of these markets up close, one does tend to draw a lot of inferences when you see a similar kind of a situation again. You tend to then kind of go back and realize that, okay, this is something which I've witnessed in the past, and this is what happened thereafter. So perhaps if I draw on my experiences and my learnings from the past, I can put this into application and look at applying this not just to managing my client's wealth, but also to my own limited pot of wealth. And I think that's something which tends to help. So I think it's been a big help, if you ask me, because then you have, let's say, much more intimate understanding of the way these asset classes behave in times of uh, you know excesses and otherwise.
So, Apurva, I think another thing which I wanted to know from you, because even the audience here is financial planners. So you have dealt with high net worth individual all your life, or maybe the last many years.
Yes.
So how is that different from a middle class guy, or what are the specific things you should keep in mind? How you do the client management, client servicing,
Sure.
how trust is important. So any advice for the financial planners today? Because
So,
most of them are dealing with the clients, a mixed set of clients. Maybe some are high net worth clients. So is there a specific strategy they should keep in mind? So maybe your
I
experience.
think let's again, a great question, Arun sir, because the fact of the matter is that I think this is a segment which is, while it is extremely high net worth in terms of their wealth, but they're also very very pressed for time. So they tend to rely on their experts a lot more, and which actually puts us in a fiduciary position, because, as you're aware, this is a business of trust, which means you need to invest a lot of time and effort in cultivating the trust. The client obviously uh, needs to believe that your interests are aligned with the client's interests, and which is the reason why I think this is a very nuanced kind of a segment as compared to let's say the other parts of the pyramid, whether it is the bottom or the middle of the pyramid. The top of the pyramid in that sense is very, very different. To me, I think two or three things are particularly critical. One is, of course, the fact that these are extremely informed investors, which means you really need to be at the top of your game. There was a time when this business, I always say that there was a time when this business was about information arbitrage. I don't think there is any information arbitrage left. Today, you get information at the same time, as your clients do. I think this is about knowledge arbitrage. So the key here is that how do you leverage, or how do you build that level of knowledge and experience, which you can then apply to managing your clients well. That's an extremely important thing to do. The other thing is, of course, the fact that I think the source of wealth for our clients in most instances is their business. I think the mistake a lot of people make is that they focus on the client and not on the business. To my mind, I think you need to have equal amount of focus on the client's business, because that business is the source of wealth. How the client monetizes that business, whether it is in the form of dividends or capital gains or any such thing which may take place, is something which eventually leads to the creation and addition to the wealth pool. So I think wealth managers, to my mind, who cater to this segment, need to know the client's business a lot more intimately, and they should be very mindful of what are the potential points of impact on that business. Is that business a cyclical business? Is that business a leveraged business? All of this is something which should give you insights in terms of how you should build a portfolio, so that if the client is in a cyclical business, you create a portfolio which is counter-cyclical. Or if the client's business is highly leveraged, then you should not deploy any kind of leverage in the client's portfolio. So these are, I think, a lot of nuances which are more, um, relevant to the high net worth and the ultra high net worth set of clients. And that's where I think, like I said, wealth managers who cater to this segment really need to be on top of their game.
Great answer. And one more thing, how to know what is happening around you, because there is an information overload.
Oh,
So how
yes.
to keep yourself updated? So because you have limited number of hours every day, then you have to meet clients and then you have
True.
to read. So maybe what to leave, what to read, what not to do. Maybe a little bit of then the preparation part. Any words on that?
No, it's extremely important, and I think there is a plethora of information which come to you, whether it is through social media, whether it is through newspapers or periodicals, whether it is through websites or through subscription services. I think I've realized that one needs to kind of narrow the focus in terms of what you really want to look at. So while there are multiple publications, I make it a point to read only two or three of them, but those I read threadbare. So I make it a point that for most of the week I will read one of the pink papers. Over the weekend I will read a different periodical, and I will subscribe to one or two services which typically tend to kind of do a lot of filtration at their end, where they decide they have seen, and how AI has been working, right? So once they see the kind of content that you are interested in, they tend to filter out the noise and give you something which is a lot more relevant. I think there is also a lot of interesting, let's say, news flow, whether it is through research reports or through publications, which tends to come in. What I make it a point to do is that in the event I get something over the course of the week, I mail it to myself, and then over the weekend I tend to consume my own mail. I've realized this has been my hack to to kind of filtering out all the noise and reading something which I think is more relevant. Um, I also tend to use my time quite judiciously, so I follow a few very interesting podcasts where you have you have some of the best brains coming in, and either in an interview format or in a narration format, they tend to share very valuable insights. So something like this keeps me updated. And I must confess, this must be only a fraction of all the news flows which come my way. But over a period of time, I've started now focusing more on these specific and relevant, um, inputs rather than in the entire over the entire universe.
Yeah, I think great. I remember last few years you have been sending me also a lot of weekend readings and very selected niche
Yes.
places. So I think that's one. I think
I actually act as the second level filter, Arun sir.
yeah.
I filter further what I receive, and then I
Yeah.
send it out to you and to some of my friends.
Because all those are great reads. I really appreciate that.
Thank you.
That is one good learning. Now I think you come across a lot of difficult client also, and they would haggle for pricing. Somebody would haggle. Somebody would Google it and then come to you, and he would talk as if he's the advisor, and maybe you have to listen to him. So what are the things you keep in mind when you handle these tough clients, and what are the negatives you think in a planner which one should avoid? What are the things not to do as a planner? So maybe this difficult situation, how to come out of that? Any thoughts on that?
No, we do have clients who are extremely price sensitive, and we do have clients who tend to be they tend to kind of get into more microscopic discussions when it comes to pricing. I'm sure a lot of people will vouch for that. But when was the last time you actually saw somebody haggling with a doctor for fees? Right? When was the last time somebody went to a Supreme Court lawyer and said that, okay, instead of X amount of fees, I will pay you X minus 10% or 20%? I think we are not there yet, but over a period of time, I think we can try and perfect our practice to get to a stage where clients aspire to be managed by us. To me, I think that is the litmus test of a wealth manager, where the last point of discussion with the client is pricing, and the client is essentially more a price taker than a price giver. Um, I don't think we are there yet. I think that's because somewhere the industry is kind of uh, being a little different in terms of the whole pricing mechanism. As you're aware, today, large clients essentially prefer to work, with their wealth managers on a fee-based model. they would prefer to work on a fee-based model. And I think again there are multiple permutations available in terms of the way these fees work. But at our firm, we are very clear that we don't we don't negotiate on fees. We think we add a lot of value to our clients, and clients are appreciative of that. So despite all the headwinds around us, we make it a point to work with a particular fee structure which we think is reasonable for both the client and for the firm. Now, yes, there have been instances, and unfortunately, as tends to be the case, we've had instances in the industry where people have kind of missold or misrepresented, investment ideas to clients, and that has unfortunately led to some bit of lack of confidence. But I think this is where one can stand out in a crowd and make sure that you build a practice where clients actually want to be managed by you, because um, your guardrails on managing each portfolio are completely unimpeachable. Your conduct is by far the best in the industry, and that shows in terms of the performance as well. So to my mind, yes, it is a cluttered space, but I think with the right set of practices, one can build a very, very strong kind of a brand for oneself and one's firm, in this space.
Great. And the role of technology now. So now technology is very, very important. And then you would find sometimes families where the father is obviously not interested in technology. He would want to meet you and talk to you. And the next generation would say, okay, you send the plan, and maybe he would also look at some of his apps and do it yourself kind of an approach, or maybe get into robo advisory. So something, how much technology is good and where technology fails, like in this game, where you feel the technology is not that important in what scenario. So basically a little bit on those areas, can you throw some light?
I think technology has been a huge enabler in our business. I think the amount of time we used to spend earlier in terms of analysis or building recommendations, a lot of that has got automated. My firm has been a huge believer in technology, and we've invested in extensively in this space. This is something which has helped us free a lot of bandwidth so that we can actually focus more in terms of how the portfolio construction should be, and what our recommendations on portfolios are. And yes, you're right. There are multi-generation families where there are different preferences. I mean, typically, the senior members of the family tend to be more, they tend to follow a more consultative kind of a model where you need to meet them on a fairly regular basis, review their portfolios, offer your recommendations. Typically, the next generation tends to be extremely mobile. They tend to travel extensively, whether it is for work or leisure. So your communication with them is actually more digital rather than in person. But I think the good part is that in this segment, the ultra high net worth segment that we work in, there has typically been a bit of a hybrid model where you've leveraged both a personal connect, and of course you've also kind of, on the other hand, used technology very extensively to make sure that the solutioning that the client experiences is the best of both worlds. I don't think we will gravitate to either end. I think we will kind of find a balance somewhere in the middle between the digital and the in-person kind of space, and that's what I think for different types of clients we've been able to build. That we've been able to strike the right balance in terms of the manner in which we engage with them and the manner in which we manage their portfolios.
Great. So now, because the audience here is financial planners, so maybe how do you see the role of financial planners, or maybe the role of financial planning in the years to come now? And obviously now, as you said, technology is also becoming important. So there is robo advisory, there is AI. So where the planner would play a role which is much bigger than what this technology will do. How can they add more value with the help of this technology?
It's actually very remarkable, but I was just a small analogy which comes to my mind that we won the World Cup about a fortnight ago. And if you see the news coverage that has happened over the last 15 days or so, I think the coach, one of my favorite cricketers, Rahul Dravid, has been as much in focus as the rest of the team, including the captain, right? So I think, to my mind, this is just one small analogy which I was giving in terms of how the role of the planner really comes into prominence. I do think that the way forward is going to be much more complex because we're kind of seeing the markets now find their, their level of perfection, if you will. Which means, unlike earlier, the the kind of mispricing opportunities that we've seen in the past may not happen as much in the future. Which means, the do-it-yourself model, which a lot of clients have been following, where they may have seen some varying levels of success, may not necessarily be the best model going forward. Which means the planner's role becomes even more critical going forward. And I think that cannot be understated. So to my mind, I think people who are in the financial planning profession are definitely, they're perhaps in the right profession at the right time, because the addressable audience is growing. The number of clients that you can service, that you can manage is increasing, manifold. The good part is technology has enabled you to manage much more, a much wider set of clients as compared to what you could have done in the past, where the use of technology was relatively limited. And thirdly, and most importantly, is the fact that I think clients are also now warming up to the idea of working with planners, so that they are able to focus more in terms of their source of wealth creation. Allow me to give you a couple of examples. We have a remarkable instance where one of the leading doctors in the country, who perhaps does multiple surgeries every single day, takes out time over his busy schedule once every month to get into a portfolio review discussion with the wealth manager, where his endeavor is that, look, I'm focusing on my profession, but the wealth that I've created, it should keep pace with what I'm doing. Ideally, it should exceed the pace at which I'm my let's say my inflows are growing, but at the same time, at the very least, I expect it to keep pace, right? So that's an example. We have several instances where clients are focused on developing and expanding and growing their businesses, and they're extremely short on time, and they really need to have a trusted financial planner who can work with them on managing their wealth and the increased inflows coming their way. So I do believe that I think this is, to my mind, actually the golden era for financial planners, and they should be well equipped to take advantage of that.
I think good to hear that, and quite reassuring. The role of financial planner, what you are saying is, so what would you advise to a fresh CFP? How should, if so, there are two kind of careers. One, he can join a company like yours or any mutual fund or any bank or BFSI segment, or he set up his own practice. So what is your advice? How should we go about this? And what are the 3 or 4 things he should keep in mind if he has to do well in his career?
First things first, I think whether you are starting off independently or whether you're working with an institution, it's very important for you to make sure that you kind of build the right clientele. How you build the right clientele, of course, there's no short formula for success. But the fact of the matter is that you can find the right set of clients where you invest disproportionate amount of time and efforts in, help them you know get their finances in order, build a very comprehensive financial plan, make sure that you are actively engaged with them, you review their portfolios on regular basis, wherever course corrections are required, you make those course corrections. Typically what I've seen is that you know people in India fortunately tend to be very liberal with references. So they would, in the event they're satisfied with your efforts and they're happy with what they've seen over a period of time, start warming up to the idea of referring you to their friends and families and associates and peers. And that's something which can help you make further inroads into a particular segment. I know of people who actually kind of focused on a particular industry or a particular profession and have been able to build a very, very thriving practice, considering the fact that they've there's been very positive word of mouth about them. That's point number one. Point number two is that I think you need to invest extensively in yourself. Now, this is again irrespective of whether you are independent or you're working with an institution. But what clients expect from you and what you should kind of set a much higher bar for yourself is how informed are you about what is transpiring. Today we are in a very connected economy. We are globalized in the true sense. Uh, an event which happens on the other side of the world has ramifications on our capital markets that could impact the way you create your clients' portfolios or the way you rebalance your clients' portfolios. And this requires you to then kind of really stay ahead of the curve in building your views. Like I said, you need to understand your client's business. You need to kind of go deeper into the industries that your clients are belonging to. You need to be there. You need to stay ahead of the curve. There's so many events which are happening where your clients because of the fact that they have paucity of time, they may not be aware. I think it is incumbent upon you to kind of bring this to their attention, whether or not it impacts their wealth. That's secondary. Fourthly, I think it is again very important that you you kind of have a certain frequency of engaging with these clients. Don't overdo it because that will kind of become very disruptive for the client. But make sure that you find the right cadence for every client relationship. I mean, we've known of clients who typically want to be they want to meet once every 3 months, and we also know of clients who want to meet every fortnight. So that they can take stock of what is happening to their portfolios. That's absolutely fine, but be patient, give them time, give time to the clients' investments also to mature in season with the passage of time. These are just some top of the mind recommendations that I can put forth, Arun sir. I think as you start building your practice, you tend to kind of get into that groove, where you then tend to kind of have the right approach for each relationship that you manage. I think that's something which will happen with the passage of time.
Great. I think before I open up for Q&A, audience Q&A, one last question I had. So some of the areas in financial planning which are not discussed much is, let's say, estate planning and risk management. Whereas I think investment, everybody would talk about, tax, everybody would talk about, insurance, everybody would talk about. So is there an interest in the universe you deal with high net worth? So do they still talk about making a will or a trust, or do you advise that some of the financial planner, they can specialize in these areas? Is there a demand? Is there a growing demand and people are talking about this?
I think there is extensive interest in this space, especially as families are becoming nuclear, and again, families are also kind of getting global. Today, how many clients do we know where some of the other family members are non-resident? And this means that the family is exposed uh, to various aspects of tax or FEMA, which conventionally they may not have been privy to, or they may not have been exposed to, which clearly goes to show that I think there is a latent need for clients to start focusing, in terms of how they want to transfer wealth to the next generation. The pandemic has actually kind of, in a way, brought forth that realization that we are living in very uncertain times, and people who perhaps were, in a way, not prioritizing these discussions, those discussions have now started taking center stage. At my firm, we have been very clear about the fact that this is an extremely critical area. We actually have an in-house team which engages with our clients in terms of understanding their financial planning, their succession planning needs, and building the right set of solutions for them. I think this is a practice which, the ones who are more interested in this can start specializing in developing their own skill sets in this space. But the good part is that there are professional firms out there which you can work with. You can enter into a collaboration, leverage their services and engage with your clients, work with them, to a referral kind of a mechanism. Or of course, if you feel that this is something which, piques your interest and is something that you would like to focus more extensively on, then please build your own skill sets, in this space. Obviously, to me, this is an extremely important solutioning that our clients tend to look for. And for people who tend to identify these needs, the better it is. You also touched upon risk management, Arun sir, and I think I'll spend maybe just a couple of minutes on that space. I don't think we as wealth managers tend to talk about risk as much as we talk about returns. I think it's a big mistake because especially when you are in the midst of a booming bull market like we are in right now, we tend to ignore the downside that clients could see. But less than 4 years ago, all of us were in a situation where we were unsure in terms of what the world will look like. Forget next year, a few months down the line. So I think risk management is extremely important. There used to be a time early in my career where our discussion with clients used to be about simply finding the right asset allocation mix for them. We would typically take them through a 8 question or a 8 point or a 10 point questionnaire, and basis which we would kind of draw up a risk profile, and we would try and kind of make sure that we adhere to that risk profile in their portfolios. That doesn't apply anymore, because today, yes, you need to understand your client's risk orientation, but more importantly, you need to put together an entire framework in terms of the way the client's wealth will be managed. So today, whether it is an investment policy statement or whether it is an investment policy set of guidelines which you need to draw up, which talks about how the portfolio will be managed, what will be the percentage exposure to each asset class, what will be the limits within which you operate. What will be the right benchmark to assess the performance of the portfolio? What would be the provision for liquidity in the portfolio? What would be the allocation to illiquid investments in the portfolio? What would be the allocation to private market investments in the portfolio? All of this is becoming more and more critical. And I can't imagine just how extensively people have been kind of now investing time and effort in terms of drawing up these charters for the clients and for the families that they manage. And the best part is today you have technology available which can act as a guide to ensuring that this charter is followed in the right earnest. So if there are any breaches or if there are any deviations to the risk mitigation or other risk guidelines that you put in the framework or in the portfolio, these can be flashed to both the client and the wealth manager so that corrective action can be taken. I think risk management is something which we need to prioritize. In my experience, very few people tend to focus on the risk element of the portfolio. I genuinely think this is one way in which you can differentiate yourself.
Great. I think very well covered. Very well said. So thanks, Apurva. We have covered a lot of ground. So we'll take some audience questions. So Saniya, can you help now?
Hello there. It was a pleasure listening to you both. Being from a younger generation myself, I do find this very insightful, and I hope our audience has also got to learn a lot from your talks here. So let's switch on to questions. We have received a few questions. We won't be able to attend them all, but we'll try managing to attend answer all of them. So let's take the first one. Sir, please suggest some podcast channels that you personally view, because as professionals in today's day and age, have correct information has become crucial due to difficult. Okay. Okay. So basically, they are asking that if you could suggest any podcasts that you listen to and
I
that
can
are
tell you about a few
reliable.
that I follow. The good part is that if you follow one, then the platform itself will start recommending quite a few to you. So
Yeah.
one of the first things that I hear in the morning is something called FinShots Daily, which are
Okay.
these short 6-7 minute news capsules which talk about something which is very pertinent, very very relevant. There is also something which comes out of the Ken called Daybreak, extremely relevant and very useful. I've been a huge admirer of Morgan Housel. I've read both his books extensively. I follow his blog regularly. He does a podcast where he speaks himself about some of his ideas, his thoughts. So I think that's something which I find quite relevant and quite useful. What else? I read the morning brief from the Economic Times. I listen to the morning brief by the Economic Times. I think they take one subject and they cover it very very extensively. Yeah, so these are a few of the podcasts which come to my mind. I had to kind of pick up my phone and look at which are the ones which I follow. But yeah, so my drive to my office in the morning is spent listening to these podcasts. Sometimes over weekends when I'm trying to get my exercise, this is what plays rather than music. As I try and kind of do my rounds.
I think while traveling, listening to the podcast has become the thing of the day
Exceptionally,
nowadays,
I,
no?
I, I agree.
Yeah.
Very useful.
Yes. Okay. So, very rightfully answered. Even I'll try to catch up with some of the suggestions that you made right now. We also have another question here. How should we convince a client that they do need a wealth manager or a financial advisor to advise when it comes to financial planning and achieving their goals? So, how should we convince a client that they do need
Same,
such a person in their life, like a
this
doctor,
the
if you
same way
need a
the same way
doctor,
you
right?
convince the same way you convince somebody that you need a gym trainer or you need a
Or a
specialist
doctor.
or a doctor. Absolutely. No, I think see the fact of the matter is again it comes back to the source of wealth, Sania. The point that I was
Yeah.
making. Our clients have generated wealth from their businesses, their professions, their occupations. And for instance, I come from a family of doctors. My younger brother is an established doctor in my hometown. And I keep telling him, saying that, look, most of your day goes in surgeries, in meeting patients. You know, there is going to be a limitation to how much time you'll be able to allocate to managing your wealth. Somebody has to do it for you. So don't think you have the ability, the inclination, or the time to do it entirely yourself. He's an active reader, so he tends to kind of take time out of his schedule and he reads a lot, he reads extensively. My point is that yes, 10-20% of your portfolio you can manage yourself, maybe 30%. But if you think that the entire 100% is something which you will be able to manage, considering the paucity of time that you have, your busy schedule, I don't think that's likely to work. Unfortunately, we tend to we've agreed to disagree on this point. But the point that comes out very clearly is that I think our clients need to focus on the source of the wealth, and they need to leave, or they need to outsource rather the management of that wealth to a specialist. That's really where the wealth manager comes in.
Very
So
rightfully
it's all
said.
about sourcing and outsourcing, like I was saying.
Arun, so you have anything to add here in this one?
Yeah. So I think Apurva covered it. I also meet a lot of people who take pride in telling me that they have achieved so much in life, so they are qualified. But when they talk about money, they are slightly apologetic. So you have to be unapologetic, and you can't say that I have a plot and I don't do anything. That means you are telling me that you are a fool. So maybe you need a financial doctor. Maybe these are some of the things, but yeah, over a period of time, I think it would come, because in Shastras they say there are four purushartha: dharma, arth, kam, moksha. So arth is sampatti, the money, and that is 25%. So maybe one should look at this aspect of the life also and be unapologetic about seeking advice for money. I think that's what I would want to add.
That's so true, sir.
And especially with now the younger generation earning more and getting the employment, we need to learn like how to manage our finances. It has become more important than ever. And with that, I would also like to ask a personal question from my end,
Sure.
that what is your opinion, and what are your thoughts on introducing personal finance as a subject in schools itself, so that the kids who come out of the school, who graduate from school, they at least are aware of their own, like, basic things that, if even if you have a financial advisor in the future, you will know what that person is trying to pitch you, so you are able to make the right decision for yourself and not completely rely on the person in front of you. So what are your thoughts on introducing this personal finance in schools?
I think it should have been done many years ago. But better late than never. I think I see now, for instance, in my daughter's school, they've done modules on
Okay.
financial planning. They've had professionals who come in and spoken with them about saving, investing, different asset classes. They've talked about, how to use a bank account, and, what should be the right, mechanism, how to use credit, at what stage to use credit cards, and when to use your own funds, and so on and so forth. And I think it's extremely heartening to know that at this early juncture, we're kind of informing or updating them in terms of various aspects of personal finance. um, I, I firmly believe that this is something which should be incorporated much more stringently. I don't know whether there is scope to incorporate this as a subject, but I genuinely think that as a module, this should get brought in. I remember when we were in school, we used to learn about simple interest and compound interest. But the fact of the matter is that we never really learned about the impact of compound interest.
Correct.
And I'll give you a classic case in point. I think this is something which is one of my favorite examples. That this was back in. I'm sorry, Arun sir, I'm going to deviate
No,
for a
no,
minute.
please
No
continue. We
worries.
are here to listen to you today. Yeah.
Thank you, thank you. No, so it's interesting. My father is an engineer, and to this day he runs a small engineering practice back home. And I used to tell him, like most elder sons and fathers, we used to have this disagreement in terms of how he would be managing his finances. So when I was doing my MBA, I used to tell him, saying that, look, why do you invest in stocks yourself? Why don't you invest into mutual funds? And this was the mid 1990s, where mutual funds, unfortunately, India had not really established themselves. So it's interesting. He actually came to me sometime in, I think it was in the end of 95, where a particular, let me not give the name, but a particular industrial house in the country, which is very prominent industrial house, launched their own mutual fund scheme. So he came and told me, he said, you keep telling me to invest into funds. So, this is an offer which has come in because I'm a shareholder in this company. They're now asking me to invest in their mutual fund. Should I invest? I said, by all means, please invest. Now, there are breed of buy and hold investors. My father is a buy and forget investor. He buys and then he
Okay.
forgets that he has it. So it so happened that this was in 1995. In 2015, this mutual fund completed 20 years of existence. And I remember a CEO calling me and telling me, saying that, look, we are doing a small celebration for our 20th anniversary. And I told him, I said, my father would be very happy to know that. He said, why? I said, because he's an original investor in your fund. He said, can you please give me his number? I'm like, why? He said, no, because I can't think of anybody who's an original investor, who's been there with the fund for 20 years. I told him, I said, sure, by all means. So suddenly, my father's getting cakes and bouquets at home and he's calling me, he said, look, what is going on over here? I told him, I said, this is a reward for your patience. Now, the interesting thing is that, that was in 1995. So this fund is on the verge of completing 29 years. Right? Can you believe it? Take a guess as to a unit purchased at a face value of 10 rupees in October of 1995. What is the value of that unit today? Take a guess. It's almost 4,000 rupees.
Okay.
4,000 rupees. So now when I meet him, my discussion is that why did you invest so less? Why didn't you invest more? So that, not just you, even I could have retired.
Yes.
Point I'm trying to make is that invested has compounded at a rate of nearly 23% over the last 29 years.
Because the world needs you, so you can't retire, Apurva. So you have to.
No, I can assure you, sir, even if I retire, I will stay within the industry.
Then it's good. Great,
no,
yeah.
so, to my mind, I think, these are all learnings which we've seen, which, we should incorporate in terms of what we do. I did make this point about patience being extremely important. I think this is, to me, an example of patience, really.
Definitely, sir. Money comes with patience and perseverance. So
Yes.
the next question, I think I'll redirect it to Arun, sir. This is from one of our CFP professionals, I'm assuming. How to handle when clients do not share their information fully?
Yes.
I think Apurva is well qualified, and then I will add Apurva.
Okay.
It's important for us to kind of give clients the comfort that whatever they share with us will stay confidential. I think that's extremely important. A lot of times, clients tend to be a little circumspect about sharing information because they don't know just how discreet the wealth manager will be with that information. To my mind, it becomes extremely important. I'll give you a classic example. I had the opportunity to meet up with a very large family. That family was being advised by multiple advisors, and they've also kind of have some friends and family who they follow. So they, over a period of time, had created a bit of a mixed bag of portfolio investments. In our initial discussion with the family, when we asked them, when we told them about our credentials and we requested them to give us the ability to work with them, they did highlight the fact that they have a huge mix of assets in their portfolio. We in fact offered, we said, why don't you share that with us so that we can kind of do our own analysis, our own evaluation of those investments, and we can come back to you. They looked at each other, they were unsure, and then we did the following. We told them, we said, don't give us the values, just give us the percentages. We don't need to know what amounts you've invested. Just give us the percentages and allow us to come back to you. We will have no idea in terms of how the assets have been allocated. That idea resonated very well with the family. So they actually did share with us, their holdings in percentage form. And when they saw the kind of work that we did, because by that time we'd done our extensive risk profiling, we realized that a lot of those investments were not in sync with what the family's risk profile was. When we went back to them with our recommendations, they were very delighted. In the very second iteration, we actually shared the entire portfolio with us. Sizable portfolio, but obviously we're discreet. That we will not discuss that with anybody. These are nuances which need to be taken into account. I think clients need to appreciate the fact that information will stay confidential. B, it will be used productively, used for their own good, their own benefit. And C, this is something which will kind of help create the right model for how the client's wealth will be managed going forward. I think once you are able to give that confidence to the client, they tend to reciprocate by being much more candid and open with you. Arun sir, if you'd like to add to this, please.
So I would add perspective from the FPSB side or CFP side, because we have a segment on ethics. I think that is what we have studied and we have agreed to obey that. And at the same time, the kind of trust you develop over a period of time. And in the private banking also, Apurva, I think we have seen that it was a sin. Even if you talk in the lift to someone, two private banker talking to each other, and if the boss comes to know, they can actually lose their job. It is that sacrosanct. It is the kind of confidentiality you have to maintain. So I think this is a given, but you have to share like you share with the doctor. So I think the client gets that kind of a comfort then he would share. But from the professional side, I think we should also be respecting that information to that extent. I think that is what both sides important.
Absolutely, absolutely.
Okay, I'll just ask two more questions.
Sure.
Right now, we are receiving a lot of questions. In fact, I'm trying to lessen it. 1 second. Okay, there's one question. So you have been in the industry for a prolonged period. Investors are changing their investment approaches, and the Indian market is wide awake now. Although we are aware of the market today, we meet a different set of people every day. So what, according to you, is an ongoing or upcoming trend in the market that is here to stay, and we as professionals should adapt to it?
Look, I've not been one for following trends, but I know for a fact that I think the Indian market has been an extremely secular market. Unlike a lot of our emerging market peers who are extremely dependent upon one or two sectors to drive their economy, ours has been a multi-sectoral kind of an economy and hence a capital market. So I have not been one for working with trends. I genuinely think that in India, there is opportunity everywhere. Having said which, if there are a few trends that you want to look at, the problem with a trend, Saniya, is that that a trend is conventionally very short-lived, which means unlike a broad-based portfolio where you can take a, like I said, buy and hold, buy and forget kind of a call. With a trend, it becomes important to time both your where the point I was making, and Arun sir, I'm sure you will agree, is that I think rather than chasing trends, it is best to actually kind of understand the client's profile and build a more broad-based and a more secular kind of a portfolio. Yes, you can keep some allocation for tactical opportunities which could come your way. But to my mind, that tactical allocation can at best be 10 or 15% of the portfolio, or rather, not just of the portfolio, of the
And I think all the planners today or audience today would have that renewed sense of reassurance that financial planning is important and they are doing the right word. Because listening from you at that level, that's the purpose of this series, that people at your level come and tell us about what is happening in this area and also share your personal investment journeys. So thanks a lot. I think Sanya is also back, but I think more or
Yeah,
less we have concluded. You want to
I'm
say
so
last
sorry. I
word?
had a poor internet connection out here.
No problem. No problem. Okay. So
No,
I think
thank you once again for giving me the opportunity, Arun sir. Thank you for hosting the event so well, Saniya. I really enjoyed this interaction, and it's always a privilege to interact with Arun sir. Um, my best wishes to you and the entire community of financial finance professionals who are participating in this program. I'm very upbeat about the opportunities which are there in this business, and my best wishes to all of you for your success.
Thank you so much, sir. I'll quickly conclude this webinar now. Thank you so much, both of you all, for sharing your invaluable insights with us. Your knowledge and experience has provided us with a deeper understanding of financial wisdom and how to effectively manage our portfolios. And thank you to all our past participants for joining us for this informative session today. We hope you found it enlightening as we did. And kindly note that that all the CFP professionals have the opportunity to earn 2 CPD credits via this webinar once it has been uploaded on your LMS portal within 2 weeks. And this webinar will also be uploaded and made available on our official YouTube channel by Monday. And please stay tuned to our social media channels and watch out for our continuing engagement opportunities that we create for you. And thank you once again for joining us here. Have a great evening, everyone, and see you next time for the next episode on Pockets to Portfolio. Thank you, everyone.
thanks. Bye.
Thank you, sir. Bye.
Bye.